At 3:47 a.m. on September 14, 2008, Dick Fold's phone lit up. He already knew what it meant. He just didn't know the number yet. By morning, it would be $639 billion. That's a margin call. And here's what nobody tells you. 3 crashes, 3 centuries, 1 identical countdown. Every single time, someone saw it coming. Every single time, they had a window, a tiny 48-hour window where they could have stopped it. Every single time, they didn't. Today, we're going inside those 48 hours. The same phone calls, the same desperate meetings, the same impossible math. Like Finny says, when the phone rings at 3 a.m., it's not your broker calling to say congratulations. Welcome to Finny Chronicles, where history meets money, power meets consequence, and every story is a warning somebody ignored. Before we dive into the chaos, let's get this straight. Say you have $10,000. You borrow another $10,000 from your broker. Now you're playing with $20,000. If the market goes up, you're a genius. Your returns are doubled. If it goes down, you're getting a phone call. Your collateral isn't worth what it was. Deposit more money today or we're selling your stocks. That's a margin call. And if you can't pay, they sell at whatever the current price is, even if it's the worst possible moment, which creates more selling, which crashes prices further, which triggers more margin calls, a doom loop, a death spiral. Like Finny puts it, margin is just confidence with a payment plan, and payment plans have due dates. Now let's go back to where it all started. October 1907. America doesn't have a central bank, no Federal Reserve, no lender of last resort. The financial system is a patchwork of independent banks, trust companies, and brokerage houses, all connected, all fragile. 2 speculators, Hines and Morse, try to corner the copper market using borrowed money from banks they secretly control. Classic Wall Street scheme, classic Wall Street ending. The corner fails spectacularly. United Copper stock crashes 90% in 2 days, and suddenly everyone realizes the banks behind this scheme are in trouble. October 22, 1907, the Knickerbocker Trust Company, the 3rd largest trust in New York, faces a run. Depositors line up around the block. They want their money. All of it, now. The 48-hour countdown begins. The Knickerbocker Trust had 48 hours. Lehman Brothers had 48 hours. If you want to see who survived and who didn't, keep watching. And if you want more stories like this, hit subscribe. We're building the complete history of money and collapse on this channel. Okay, back to the story. By afternoon, Knickerbocker has paid out $8 million. Their vaults are emptying. Charles Barney, the president, reaches out desperately. He needs someone with deep pockets to step in. There's only one man who can save him. John Pierpont Morgan, the most powerful banker in America, perhaps the most powerful private citizen who ever lived. Morgan reviews Knickerbocker's books and refuses to help. October 23, 1907, the run intensifies. Knickerbocker's remaining reserves evaporate in 3 hours. At 12:30 p.m., they close the doors. Knickerbocker Trust has suspended operations, and the panic spreads. Like Finny says, panic is the only thing that moves faster than money, and it doesn't need a train. Other trusts face runs. Stock prices collapsed. The New York Stock Exchange is on the verge of shutting down. 24 hours left. J.P. Morgan summons the leading bankers of New York to his personal library and literally locks them in. He tells them no one leaves until they agree to pool their resources and save the system. The negotiation goes all night. By morning, they have a deal. $25 million pooled together to restore confidence. Morgan personally walks under the floor of the New York Stock Exchange. His presence alone calms the panic. The 1907 panic is contained, not by the government, not by a central bank, by one man with a library and a locked door. Like Finny observes, when there's no safety net, you better hope the richest guy in the room feels generous. Fast forward 29 years, America has learned from 1907, sort of. They created the Federal Reserve in 1913, a central bank, a lender of last resort. But they also created something else, the easiest access to margin debt in history. By 1929, investors can buy stocks with as little as 10% down. Put up $1,000, control $10,000 in stocks. Everyone is in the market. Shopkeepers, teachers, janitors. Everyone is leveraged. Everyone is winning. Irving Fisher, the most famous economist in America, declares that stocks have reached a permanently high plateau. 3 days later, the plateau collapses into a canyon. October 24th, 1929, Black Thursday. The market opens down, way down. Margin calls go out by the thousands. A broker in Chicago picks up the phone. His client is a school teacher from Milwaukee. She put her savings, $2,000, into RCA stock last spring. Her brother-in-law told her it was a sure thing. Mrs. Henderson, it's about your account. We need more money by noon. She doesn't have it. Every dollar she had went into the market. I'm sorry, he says. We're selling everything. He hangs up. He has 40 more calls to make before lunch. The leading bankers meet. Same playbook as 1907. Pool money, restore confidence. Thomas Lamont announces to the press that there's been a little distress selling. For a moment, it works. Prices recover slightly. Friday, the market holds. Barely. Everyone waits through the weekend, praying. October 28th, 1929. Black Monday. The market opens with a wall of selling. The ticker falls behind. Prices are dropping so fast, no one knows the actual value of their portfolios. You're watching prices from the past, and the present is worse. Brokers don't even call anymore. They just sell. The Dow drops 13% in a single day. And then comes Tuesday. 16 million shares trade, a record that will stand for decades. The market loses another 12%. In just 2 days, the stock market has lost a quarter of its value. Mrs. Henderson from Milwaukee loses everything. Her savings, her house by the following spring. Her faith that the system was fair. Like Finny says, the 1920s invented YOLO investing. The 1930s invented consequences. The Great Depression follows, a decade of suffering. And it all started with margin, with leverage, with the same 48-hour countdown that Morgan navigated in 1907. Except this time, the canyon was too deep for anyone to bridge. Now let's jump forward 79 years. The setting has changed. The math has gotten more complicated. The leverage has gotten even more insane. But the pattern? The pattern is exactly the same. September 12, 2008, Friday evening. Lehman Brothers, the fourth largest investment bank in America, is dying. They have 48 hours to find a buyer, get a bailout, or declare bankruptcy. Dick Fult, the CEO they call the Gorilla, has been trying to save his firm for months. 6 months earlier, Bear Stearns collapsed. The government helped arrange a rescue. Everyone knew Lehman was next. Everyone hoped it would be different. Saturday, September 13th. Treasury Secretary Hank Paulson, Fed Chair Ben Bernanke, New York Fed President Tim Geithner. Every major Wall Street CEO in one room. Paulson makes it clear, no government money for Lehman. This time, Wall Street has to save itself. Like Finny says, when the government says we're not bailing you out, that's either a bluff or a funeral announcement. The market can't tell the difference. Saturday afternoon. Barclays, the British bank, is interested in buying Lehman. For a few hours, there's hope. But the British government refuses to approve the deal without a guarantee against Lehman's toxic assets. Paulson won't provide one. Barclays walks. Bank of America, they've moved on. They're buying Merrill Lynch instead. Lehman employees start packing boxes. They can feel what's coming. Fold makes one last call to Paulson, the most powerful banker in America, calling the most powerful man in finance, straight to voicemail. At 1:45 a.m. on September 15, 2008, Lehman Brothers files for bankruptcy. $639 billion in assets, the largest bankruptcy in American history. The next morning, global markets collapse. The Dow drops 504 points, the largest single-day point drop in history at that time. Credit markets freeze completely. Banks won't lend to each other. They don't trust each other. For a few days, senior officials genuinely wonder if ATMs will keep dispensing cash. Like Finny puts it, Lehman's death certificate had everyone else's name on it too. They just didn't read the fine print. Leverage, trigger. Cascade, window, choice. Like Finny observes, the playbook hasn't changed in 100 years, just the zeros on the checks. Okay, you're thinking, interesting history, but what does this have to do with me? Everything. Because margin isn't just for Wall Street anymore. Your brokerage app probably offers margin. It's one click to enable, much harder to turn off when you need to. Crypto exchanges offer 100x leverage. Put up $1,000, control $100,000. Prices drop 1%, you're liquidated, wiped out. And the exchange doesn't call first. The algorithm just sells, 3 a.m. or not. The same doom loop that destroyed empires is now available on your phone. Like Finny says, they democratized leverage. They didn't democratize wisdom. The survivors of every crash knew one thing. Leverage feels like genius in a bull market. Leverage becomes a death sentence in a crash. The 48-hour window exists every time, but it closes fast. The people who survive aren't the ones with the most leverage. They're the ones with the least. Right now, markets are calm, but margin debt is near all-time highs. Options trading has exploded. An unprecedented number of retail investors are leveraged to the hilt. And somewhere, right now, there's someone who's borrowed too much. Someone whose portfolio is stretched too thin. They haven't gotten the call yet, but they will. They always do. Morgan knew it. The traders of 1929 learned it. Lehman discovered it the hard way. The only question is when the 48 hours begin, which side of the call will you be on? Like Finny says, borrowed money is just rented confidence, and landlords always collect eventually. 3 crashes, 3 centuries, 1 pattern. If you see it now, you'll recognize it when it happens again. If this video changed how you see leverage and risk, hit subscribe. We drop videos like this every couple of days. Real stories about money, power, and the warnings history keeps repeating. Drop a comment. What do you think is leveraged too high right now? Stocks? Real estate? Crypto? What's the next Lehman? Next time, the family that invented modern banking and the fortune that built the Renaissance. The Medicis. Coming soon.